Hi, Keith Prather here again this month with the NCM September Powersports Economic Update. Let me share my screen here real fast. We'll get right into it. So this month, and the latest data that we had is up through July. We build this using multiple different data points and inputs. And so the last month that we had all full available data was in July. The index was about 3.2% higher month over month. And so that doesn't reduce seasonality. And we know that July probably was a little bit better than June, but we saw just a little bit of a recovery and acceleration in power sports demand kind of coming through the end of July. It was only slightly lower year over year by 0.4%. And if you look, it's right back at the long-term trend line. So we would kind of say, at least for this month, and it could reverse course in another month or so, but right now it's back on trend, which is good. And then from a historical perspective, just need to point out that if you look historically, going all the way back, prior to the pandemic, we're still at demand levels that were much higher than they were prior to the pandemic. Again, back on trend, but for total output and total demand, actually looks still pretty strong. Now, for the retail sales index, when we actually track retail sales, they also rebounded. We saw 3% surge month over month, and this is again through July, down again just a little bit year over year, but remains within the long-term average range, and just a little above, where we think about as being sort of the balanced or kind of an unchanged marketplace. So, you've got an industry right now that's growing somewhere between 1 and 1.5%, which is kind of small, but inflation adjusted, it's about where it is historically. So, excuse me, not too bad overall. So we are still watching a couple other metrics, and the one that we watch the closest when it comes to power sports is real disposable income. I talked about this in the last month's recording, but real disposable income is just inflation adjusted income for households after we strip out taxes and a couple of the essentials like housing. What we're getting is a signal that just still shows that disposable income is still slipping. It has kind of flattened out a little bit over the last 30 days, which is good, but we're still only reading about a 1.1% increase in real disposable income. And we know that there's a direct correlation between auto sales, marine, power sports, and other types of big ticket, non-essential types of spending. And I know some of you are going to reach out to me and say, hey, certain categories of power sports are absolutely essential. I understand that. But broadly, at a macro level across the entire industry, it would be considered kind of non-essential spending or disposable income types of spending. So we see that tight correlation. Now, on a historical basis, when we go back into the 1960s, you can see those decade averages are still a lot higher than what we have gotten over the last couple of years. We had this big reduction in 2022, followed by a little bit of a rebound. That blended average was growth of about 1.5%. So it really has been a little bit sluggish since 2023. Again, we're trending at 1.1 right now through the end of July, and then we're getting a 1.4% forecast for the rest of the year, and then 1.4 in 2025. So a little bit lackluster, but it should still fuel some spending in the power sports category. But we've got to look at some other measures. Another measure that actually is trending pretty well for us, which gives us a little bit of optimism moving forward when we think about the forecast for the end of the year and then into 2025, is this relationship between personal wages and what's happening with inflation. So Jerome Powell, who's the Federal Reserve Chairman, watches this pretty closely. And if you look back when we got the inversion where inflation was growing faster than wages, this is when the Fed started hiking interest rates. And then as it reinverted and we moved to see wages outgrowing inflation, that's when the Fed paused and we're able to get a little bit of a sort of like a planing out of the industry, right? It started to create a baseline. This gap, this 1% gap right now between wages and inflation is actually pretty strong. When we look at it on a historical basis, that's about what we got in the entire decade between the pandemic and the Great Recession. And so you've got that 1% gap in there. So in simple terms, it just means that households on a monthly basis are able to dig out of debt. They're able to get to the point where they can consider taking on more debt and they're able to make ends meet. When we had this inversion, they weren't able to make ends meet. So every month, a big percentage of US households, about 62% overall, it's almost 78 million households, were kind of falling or kind of slipping underwater every single month. Their expenses and the cost of food, the cost of rent, the cost of insurance, all of that was outpacing their wage growth. Now, again, finally, we've been in this good ratio, which means you're going to get some activity and see some improvement in the power sports category based on that gap. The other thing that we're watching overall is a couple more points. First of all, the macroeconomic outlook shows that in Q3, we're expecting about a 2.5% growth rate. Last year, for comparison, we got about 5.2% to be exact. The difference here is that in Q3 of 2023, we had a lot of inventory building activity, which is part of that traditional retail peak cycle. So that's why Q3 last year was so strong, followed up by 2.5% growth in Q4. This year, it's a little bit weaker because we've got a looming East Coast port situation where we have a labor contract deadline hitting us on September 30th, and there's a potential for a strike or a work stoppage or a work slowdown in and around that date. So a lot of retailers inbounded their freight for the Christmas season earlier than normal. That's why we saw a little stronger Q2 than we had last year. But that's also why we're expecting a little weaker Q3. So the economy in general stays pretty strong. I mean, we don't see any recession indicators, at least based on just pure GDP at this moment. But two other factors I want to point out as it pertains to power sports. Again, we've talked about this in a bunch of the other videos for the other sectors, but the stock market has a big impact on how people spend money. Right now, the Dow Jones Industrial Average and S&P 500 are both either at or near all-time highs, and they've been there now for a little over a month. September is typically a weaker month for the stock market, and so seeing it being this buoyed is actually positive. And a lot of that's just because they believe the Federal Reserve is obviously going to cut interest rates by a quarter point this month. But last year it generated about $900 billion in stock market wealth. And we're not going to get that much this year, but we are going to get some. And that generated about $288 billion in additional spending. So that means that for a lot of households, especially the middle and upper income households, they do have a lot of discretionary income available to go do fun things like, buy something new in the power sports category. And so that's what we're watching. And so that factor is coming back into play. I think once we get the election behind us in November, once we get some of the Fed uncertainty out of the way, a lot of those consumers will come out of the woodwork. And if they have been sort of saving money, and if they haven't been spending it, we have a lot of pent up demand. And I think you could see a resurgence kind of by the end of the year, early into early next year, and specifically when we start to hit some of those seasonal periods when we see peak spending in power sports. So that would be like late spring of next year. The other factor, and the last factor I'm going to talk about that we also talked about in the RV video and a couple others, is this great wealth effect they're talking about and the great wealth transfer. And this is just the notion that baby boomers are getting to that point where they're retiring, some are passing away, that generation is just getting a lot older. And as they are, they're transferring a tremendous amount of wealth down to the younger generations. They have accumulated so much wealth because they were some of the first generations to really get involved in mutual funds, really put a lot of money back into savings. They were worried about retirement, and now they're retiring with millions of dollars sitting in the stock market. So some of that wealth transfer then translates into younger households having the wherewithal finally to go out and do some of the things they've wanted to do, whether it's a new RV, a new boat, a new motorcycle, something in the power sports category. So we're seeing that great wealth transfer, and that's what's giving us some odd economic data at times. All that market has to do is feel a little bit more optimistic about where the economy is going, and all of a sudden that money starts to flow. So that's a big factor, and I think that all those conditions should improve the outlook moving forward, even though we're hitting a bit of a soft patch right now in some ways. So that's what I had for you this month. Hope everyone is staying safe and healthy. Reach out if you have any questions. And in the meantime, I'll see you next month. Take care. Bye-bye.